Welcome back to the channel. I'm Algabot, and today we're exploring an expert advisor for MetaTrader 5 called Distributional Separation Breakout. This strategy takes a fresh angle on breakout detection. Instead of watching for a single price spike, it uses a statistical test, the two-sample Kolmogorov-Smirnov test, to measure whether recent prices have genuinely separated from the prior range. By the end of this video, you'll understand how the strategy compares two windows of price, how it decides direction, and how it manages every trade with defined stops and targets. Let's dig in. And remember, this is educational content only. So what exactly does this expert advisor do? Distributional Separation Breakout is an automated strategy designed for MetaTrader 5, and it can be applied to any symbol and time frame you choose. At its heart sits a well-known statistical tool called the two-sample Kolmogorov-Smirnov test. Now that name sounds intimidating, but the idea behind it is beautifully simple. The strategy takes two side-by-side windows of closing prices. The first window holds the most recent set of closes. The second window holds the set of closes immediately before them. Both windows are the same length, set by the sample window parameter, which defaults to 24 bars. For each window, the strategy builds what statisticians call an empirical cumulative distribution function, essentially a picture of how price has been distributed over that stretch of time. The Kolmogorov-Smirnov statistic, which we'll call D, measures the largest gap between those two pictures. D always sits between 0 and 1. When D is close to 0, the two windows look almost identical, which tells us price is balancing inside a single range. When D climbs toward 1, the recent window has decoupled from the prior one, a genuine shift in where trade is taking place. This makes the approach quite different from a classic range breakout that fires on one extreme tick. Here, the whole shape of recent trading has to relocate before a signal appears. Because the test is scale-free, it needs no per-symbol tuning. This style may appeal to traders who are curious about statistically grounded, regime change ideas rather than simple line breaks. As always, this is shared purely for education. Trading carries real risk, and losses are part of the process. Let's walk through the exact logic, step by step. The expert advisor works only on completed bars, so it makes one decision per closed candle rather than reacting to every tick. On each new bar, it records the latest close and rebuilds its two adjacent windows, the recent window and the prior window, each holding the number of closes set by the sample window parameter. It then sorts both windows and computes the Kolmogorov-Smirnov statistic D, the maximum distance between their two cumulative distributions. The strategy also keeps the value of D from the previous bar because the entry depends on a fresh crossing. The first condition is separation. A fresh separation happens when D was below the KsEntry level on the prior bar and has now risen to meet or exceed it. By default, KsEntry is 0.60. This tells the strategy that the recent window has meaningfully pulled away from the prior range. That balance has broken into a new regime. But separation alone doesn't tell us which way to trade, so the strategy adds a directional gate. It measures the shift in the average price between the two windows. If the recent mean sits above the prior mean by at least a fraction of the average true range, set by the direction DirAtrFrac parameter, defaulting to 1/2, the strategy signals along. If the recent mean sits below the prior mean by that same distance, it signals a short. This ATR filter is important. It ensures that a purely volatility-driven change, where D is high but price hasn't actually drifted anywhere, does not produce a directionless trade. Now for trade management. When a long signal appears, the expert advisor buys at the ask, places a protective stop below entry at 2 times ATR, and sets a target above entry at 3 times ATR. When a short signal appears, it sells at the bid, with the stop above entry and the target below, using the same ATR multiples. That gives a reward-to-risk shape of 3 to 2 by default. There are two more ways a trade can end. First, reversal. If the strategy is long and a fresh separation prints in the opposite direction, it closes and flips. Second, dissipation. If D falls back below the KsExit level, defaulting to 0.30, the distributions have re-merged, the breakout has decayed back into a range, and the position is closed. The code also keeps the exit level safely below the entry level, so a trade can never open and instantly fail its own exit test. Let's look at the actual MetaQuotes language code the expert advisor runs. At the top, we have the input parameters. SampleWindow sets the length of each price window, defaulting to 24. KsEntry at 0.60 is the separation level that arms a trade, while KsExit at 0.30 is the level below which the breakout is treated as re-merged. Direction ATR fraction controls the minimum mean shift as a fraction of ATR. Then we have the ATR period, the stop and target multiples of 2 and 3, and the fixed lot size. Below the inputs is the heart of the logic. The Boolean called fresh separation is true only when D on the previous bar was below KsEntry and D on this bar has reached or passed it, and that's the crossing we discussed. The strategy then computes shift, the difference between the recent mean and the prior mean, and compares it to the minimum shift, which is the direction ATR fraction times ATR. Look at the long side first. Long signal is true when we have a fresh separation and the shift is at least the positive minimum. When that holds, the code reads the ask price, sets the stop below entry at the stop multiple times ATR, sets the target above entry at the target multiple times ATR, and calls trade.buy. Now the short side. Short signal is true when we have a fresh separation, but the shift is at most the negative minimum, meaning the recent window separated below the prior range. The code reads the bid price, places the stop above entry, the target below entry, and calls trade.sell. Both sides carry defined protection from the moment they open. Now let's bring this to life on a chart. On screen, you can see a series of candles up top, and beneath them a subpanel plotting the Kolmogorov-Smirnov statistic D, our separation gauge. It runs from 0 at the bottom to 1 at the top. Two dashed lines mark the key levels, the entry line at 0.60 and the exit line at 0.30. Watch how the panel and the candles move together. Look at the first 4 candles. Price is drifting sideways in a tight band, small bodies overlapping one another. This is balance. During this stretch, the recent window and the prior window look almost the same, so the D reading down in the subpanel sits low, hovering near 0.2, while beneath the entry line. The strategy is patient here. There is no separation, so it does nothing but watch and keep measuring. Now watch the 5th candle. Price pushes firmly upward with a strong body, closing above the little range that came before. As this happens, the recent window fills with higher closes and pulls away from the prior window. Down in the panel, the D line surges and crosses up through the entry line at 0.60. That is a fresh separation. And because the recent average now sits above the prior average by more than our ATR fraction, the direction gate points up. This is where the buy entry marker appears. The expert advisor buys at the ask and immediately places a protective stop below the entry at 2 times ATR and a take profit above at 3 times ATR. Follow the next 2 candles. Price continues to climb, each candle printing higher highs as the new upward regime carries through. The D reading stays elevated, confirming the recent window remains decoupled from the old range. Then, on the 8th candle, price reaches the take profit target above entry. The long trade closes in this illustration, capturing the move that the separation signaled. Notice we never had to guess a top, because the target did its job. After that, price stalls. The 8th and 9th candles lose momentum near the highs, and the D line begins sliding back down toward the exit line as the 2 windows start to overlap again at the higher level. Balance is briefly restored up here. Now watch the turn. On the 10th candle, price rolls over and pushes down hard, closing well below the recent cluster. The recent window fills with lower closes and once again separates from the prior window, but this time to the downside. In the panel, D climbs back up and crosses the entry line at 0.60 for a second time. This is another fresh separation, yet now the recent average sits below the prior average by more than the ATR fraction, so the direction gate points down. The sell entry marker appears. The expert advisor sells at the bid, sets its protective stop above the entry at 2 times ATR and its target below at 3 times ATR. Trace the final candles. Price slides lower, candle after candle, as the downward regime plays out. The move carries price down to the take profit target below entry, and the short trade closes. Once again, the strategy stayed with a statistically confirmed shift rather than a single spike. Step back and see the rhythm. Balance keeps D low. A genuine relocation of price lifts D through the entry line, and the mean shift decides long or short. A protective stop and an ATR target bracket every trade. And if D ever collapses back below the exit line before the target is met, the dissipation rule closes the position because the breakout has faded. That is the full cycle, long and short, driven entirely by how far the recent distribution has separated from the one before it. And that brings us to the end of our look at distributional separation breakout. We covered the idea behind the two-sample Kolmogorov-Smirnov test, how the strategy compares a recent window of closes against the prior window, how a fresh separation above the entry level arms a trade, how the ATR-based mean shift chooses long or short, and how every position is managed with a protective stop, an ATR target, and a dissipation exit when the distributions reemerge. Remember, everything here is for educational purposes only, and it is not financial advice or a recommendation to trade. Trading involves real risk. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like explored next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.